My name is Alex Morgan, and today we're taking a deep look at where the US stock market is heading next, with a specific focus on the S&P 500 and the Nasdaq, and what Wall Street is really signaling for the week ahead. If you've been watching the markets lately, you've probably noticed something strange. On the surface, the indexes look strong. Record levels, resilience after pullbacks, and constant headlines about optimism. But underneath that surface, there's a lot more uncertainty than the price charts alone suggest. Right now, the S&P 500 is trading near historic highs, and the Nasdaq continues to show strength despite growing volatility in large technology stocks. At the same time, investors are quietly repositioning. Money is rotating, risk appetite is shifting, and the question many traders are asking is not whether the market can go higher, but how stable that move really is. This week is important because it's not just about earnings or a single economic release, it's about expectations. Markets don't move on facts alone, they move on how reality compares to expectations. And right now, expectations are finally balanced. Let's start with the S&P 500. The S&P represents the broader US economy more accurately than any other index. When it's strong, it usually tells us that investors believe economic growth can continue, even if it slows. But what's interesting right now is how narrow the leadership has been. A small group of large companies continues to hold up the index, while many smaller stocks lag behind. That kind of divergence matters. Wall Street has been debating whether this is a healthy consolidation phase or a warning sign. Some analysts argue that strength in high-quality companies is exactly what you want during uncertain times. Others point out that when fewer stocks are doing the heavy lifting, markets become more fragile. Both views have merit, and this tension is exactly what makes the upcoming week critical. Bond yields are playing a major role in this story. When yields rise, it puts pressure on equity valuations, especially growth stocks. When yields fall, stocks often breathe easier. Recently, yields have eased slightly, and that has provided short-term relief to equities. But yields haven't collapsed, and that suggests markets are still unsure about the path of inflation and interest rates. The Federal Reserve remains the central force behind market psychology. Even when the Fed doesn't speak, its presence is felt. Traders are constantly adjusting positions based on what they think the Fed might do next. Rate cuts are still expected later in the year, but the timing and number of those cuts remain uncertain. That uncertainty creates volatility. If inflation data comes in hotter than expected, markets may quickly reprice. Stocks could pull back as rate cut expectations are pushed further into the future. If inflation cools more than expected, stocks could rally, but even then, the rally may not be uniform. Defensive sectors could lag while growth names surge, or vice versa. Now let's talk about the Nasdaq, because this is where emotions tend to run higher. The Nasdaq is heavily weighted toward technology and growth stocks. These companies are more sensitive to interest rates, expectations about future earnings, and investor sentiment. Recently, the Nasdaq has shown resilience, but that resilience has come with sharp intraday swings. This tells us something important. Buyers are still present, but they're cautious. They're not chasing prices aggressively, they're waiting for pullbacks. That kind of behavior often appears late in a cycle, not necessarily at the top, but in a phase where investors are more selective. Artificial intelligence remains a dominant theme, but even within AI-related stocks, leadership has become more fragmented. Some names continue to attract capital, while others struggle. This differentiation suggests that the market is maturing. Early hype has given way to scrutiny, and scrutiny changes price behavior. Wall Street analysts this week are watching corporate guidance very closely. Not just earnings numbers, but forward-looking statements. Companies that express confidence tend to get rewarded. Companies that sound cautious often get punished, even if their current results look fine. That tells us the market is nervous about the future. Consumer behavior is another piece of the puzzle. Recent data suggests that consumers are becoming more selective. Spending hasn't collapsed, but it's no longer expanding rapidly. That has implications for corporate earnings, especially in discretionary sectors. If consumers pull back further, earnings expectations may need to be revised lower. Now, what could happen next? There are a few realistic scenarios that markets are weighing right now. One scenario is a continuation of the slow grind higher. In this case, inflation gradually cools, the Fed maintains a patient tone, and earnings remain good enough. Stocks could drift higher, but gains may be uneven. Volatility would remain elevated, but the trend would stay intact. Another scenario involves a sharper pullback. This could be triggered by a negative inflation surprise, a sudden jump in yields, or disappointing guidance from major companies. In that environment, the S&P 500 could test key support levels, and the Nasdaq could see deeper corrections, especially in overextended names. There's also a less discussed but important scenario where markets move sideways. Time becomes the correction instead of price. This would frustrate both bulls and bears. Stocks wouldn't crash, but they wouldn't trend strongly either. This kind of environment often leads to sector rotation and favors active management over passive investing. Wall Street doesn't see an immediate crash as the base case right now, but it also doesn't see a smooth, low volatility rally. The dominant expectation is choppiness. That's important for traders and investors alike. Now let's bring silver into this conversation because silver often reacts to the same forces that drive equities, but in a very different way. Silver is both a precious metal and an industrial metal. That dual nature makes it a useful signal. When stocks are rising due to genuine economic strength, silver often benefits from industrial demand. When stocks rise due to monetary easing or currency debasement fears, silver can also benefit as a store of value. But when markets become uncertain, silver can lag before making sharp moves. Right now, silver has been relatively subdued compared to gold. Gold has attracted more defensive capital, while silver has been caught between industrial optimism and economic caution. This tells us that the market is unsure about growth. If the S&P 500 and Nasdaq continue higher in a stable way, silver could gradually strengthen as industrial demand expectations improve. Renewable energy, electronics, and infrastructure all rely heavily on silver. That demand doesn't disappear overnight. However, if equity markets become more volatile and risk appetite declines, silver could initially pull back. But historically, silver often lags gold at first, and then catches up quickly once monetary or macro stress becomes more visible. That's why many investors watch silver closely during periods of market transition. If the Fed signals a more accommodative stance, or if financial conditions tighten unexpectedly, silver could move aggressively. Silver rallies tend to be fast and emotional. They don't build slowly like equity rallies. They break out. This week, silver traders will be watching the same things equity traders are watching: yields, the dollar, and macro data. A weaker dollar tends to support silver, especially if inflation expectations remain elevated. The relationship between equities and silver isn't always straightforward, but when both start moving higher together, it often signals a shift toward hard assets and real value. That's something to pay attention to. Zooming out, the bigger picture is that markets are transitioning. We're not in a crisis, but we're not in a carefree bull market either. The easy money phase is over. What comes next depends on policy, inflation, and growth, and those variables are still in flux. The S&P 500 and Nasdaq are telling us that investors are hopeful, but cautious. Silver is telling us that the market isn't fully convinced about growth. Gold is telling us that long-term uncertainty hasn't gone away. For this week, expect volatility. Expect headlines to move markets quickly. Expect overreactions in both directions. That doesn't mean panic. It means opportunity, but only for those who understand the environment. If you're investing, patience matters. If you're trading, discipline matters even more. The market doesn't reward emotion in uncertain times. As we move through this week, watch how markets react to data, not the data itself. Watch whether dips are bought or sold. Watch whether leadership broadens or narrows. These signals will tell you more than any forecast. We're living in a period where financial markets are being reshaped in real time. The S&P 500 and Nasdaq aren't just reflecting earnings. They're reflecting confidence, fear, and expectations about the future. And silver, quietly, is waiting for its moment. If you found this analysis useful and want clear, calm, data-driven breakdowns of the stock market, metals, and global macro trends, make sure you subscribe to the channel. Turn on notifications so you don't miss upcoming market updates, and share your thoughts in the comments below. Where do you see the S&P 500, Nasdaq, and silver heading next? I'll see you in the next video.